Welcome back to the Dividend Diplomats YouTube channel, everybody. Lanny, Bert, the Dividend Diplomats right now. In this wild and crazy stock market, we are always on the hunt for undervalued dividend stocks to buy. So what are we doing? We're putting together a watch list today to focus on 3 undervalued dividend growth stocks to keep our eye on throughout this volatility.
You're not wrong there, Bert. Before we dive into Bert's latest dividend stock watch list, make sure you guys subscribe to our channel. Give this video a thumbs up. Because, Bert, what are we trying to do? We're trying to reach the millions and millions of dividend investors and all investors out there. What a wild ride in the S&P 500 in the stock market this week. Bert, what the heck happened?
You are not kidding. All right. It started off S&P 500, 3,994, crossed up, hit nearly 4,100 at its peak on May 18th. Then it all came tumbling right back down, touching 3,800 on Friday before it finished. It kind of rebounded there on Friday, ending the week at 3,901. What a wild week here in the S&P 500.
Yeah, it's funny seeing how far it went down Friday, only to come spiraling back up to close off the day. But wow, what a great time if you're in the market to buy stocks. Specifically here, we're buying dividend stocks. So what a great time to start adding to your passive income stream for less. I will continue to say that throughout this time period. This is, finally we're back to some lower prices out here in the market. Your price per gallon may be at all-time highs. Your price for eggs and other groceries may be at highs, but man, oh man, these dividend stocks are on sale, baby.
Yeah, your price per share for these dividend stocks are coming down. That is for certain. So we're bucking the inflation trend here with some of these stocks. So what's cool about this watch list, at least from my perspective, is I own all 3 companies that we're going to be featuring, and I've already been buying all 3 companies here. So I'm going to continue watching them and continue adding to my positions in these stocks. That's what it's all about. I'm tired of adding new positions. So it's kind of nice to find stocks that you already own that are discounted. And truth be told, they were smaller positions in my portfolio entering the last few weeks, and I'm trying to correct that by building up my positions so that they're a little more substantial.
A great correction here to Bert's portfolio, aka buying current positions, building that income stream for each stock he owns. As Bert was saying, his old body sure can use a soap, to quote Major League. So, Bert, we got 3 stocks we're watching. Wow. I would actually argue these are pretty much 3 high dividend growth rate stocks. I'm very excited for you to jump in because we're also talking about 3 different industries that you're touching here.
Yep, that's right. So how do we evaluate the 3 companies? Actually, not just these 3 companies, all of the companies using our Dividend Diplomat stock screener. 3 simple metrics and a bonus metric here. 1, PE ratio less than the S&P 500. 2, payout ratio less than 60%. 3, dividend growth rate, where we look at the 5-year dividend growth rate and the history, and that bonus metric, the dividend yield. So everybody get excited, get hyped. We're going to talk about these 3 undervalued dividend growth stocks to buy.
All right, guys, let's dive in here. That first big dividend stock on his list, we're rewinding the tapes because we've been talking about this company for quite some time. We're talking to Howard Schultz. He's back at the helm. Bert, you've been picking up now some Starbucks stock lately. So SBUX is the ticker symbol.
That's right. Starbucks has been in a little bit of a slump. It's dealing with some global growth issues because of COVID. They're dealing with some union issues too in different areas. And overall, yeah, they have the CEO transition. Howard Schultz came back. I know the price popped when they made that announcement that Schultz was returning. Starbucks broke $80 a share after it fell back down, and now it's coming tumbling back down. It hit the 60s a couple of weeks ago, Lanny. I think it was, 68, 69 for a hot minute. Now it's settling back in the low $70 per share range.
Yeah, that's right. They've got a little turbulence from their plans over in China because we know of the lockdowns that are happening over there. But hey, that means great news for investors right here that are looking to build their Starbucks stock position. Currently trading at $73.39. They are down year to date, a good old 37% or almost 34% over the last 52 weeks. And guys, to dive into that first Dividend Diplomat stock screening metric, the price to earnings ratio, analysts are still expecting $3.45 on this global icon of a stock. That leads to a PE ratio of about 21 times earnings, Bert.
So not the cheapest on sale, but from Starbucks standards, a high growth stock. This is trading it at lower than their historical PE. So that's why it's popping up as undervalued from that perspective. It's definitely going to be the most expensive of the three companies on my watch list, but I don't care. I've continued buying into this thing. Let's move into that second metric here, the payout ratio, annual dividend, $1.96. Divide that by the 345. That gives you a payout ratio that is in our perfect payout ratio range, just below our 60% threshold. That payout ratio is 56.81%.
Yeah, 56.81%. And it probably is starting to creep up because of that third dividend diplomat stock metric, that dividend growth rate. Why? Because they've been growing dividends now for over 10 years. In fact, over 11 years. And they've been doing it at a heavy, high average clip. The 5-year average dividend growth rate for Starbucks is actually 16%. So if you keep climbing that, but then earnings is getting a little bit of pressure right now because of all the issues that are happening globally, plus the labor union discussions, supply chain issues, and on top of that, higher costs that are going into their goods is putting a pressure down on earnings, raising the payout ratio. But, Starbucks still has that safety in their dividend.
Yeah. And I would assume that moving into the third metric here, with all of those headwinds we're facing, we are not going to see a dividend increase that's going to match their 5-year dividend growth rate of 16.05 this year. I'm going to make that declaration now. We are not going to see a 16% dividend growth rate, probably something lower this year as they work through it. But on a 5-year perspective, that is a very strong dividend growth rate. Taking a step back, before some of this stuff happens, Starbucks, growth stock, high growth earnings, high dividend earnings. That's why people like Starbucks. That's why I'm so excited to grab and continue building my position in Starbucks. They've increased that dividend now for 11 plus years. So they are on that way to becoming a dividend aristocrat. They're almost halfway across that journey.
Nice. And guys, look at that bonus metric, that dividend yield. It's now creeping up, getting close to that 2.7, 2.75%. They're at 2.67% as of May 20th close. So, almost double the S&P 500, because we'll talk about that later on in the week. But that VOO, Vanguard's ETF dividend yield is well over 1.5% now. Yep. So keep that in mind.
Yep. To summarize, Starbucks, 21 PE ratio, 56% payout ratio, 16% 5-year dividend growth rate, 11 years of increasing that dividend consecutively, and a 2.67% yield. Let's move into that second stock here. This is one that hasn't popped up on my watch list for a very long time. It's been a while since we've talked about this company here, so this may be a little bit of surprise to some of you viewers. This company is Qualcomm, ticker symbol QCO. We're moving into the technology sector, into the chip sector here, Lanny. Isn't that right?
Moving into the chip sector, again, a lot of headwinds as well facing the chip sector. Nobody is, I guess, vaccinated from the headwinds of supply chain, as well as the labor shortages to create and make, chips. So guys, Qualcomm, though, is in almost so many mobile devices. I'm pretty sure our phones right now are running a nice Qualcomm Snapdragon processor. But man, this stock has been hit so hard this year. But they've been stunned. They've been pedigreed. And I think HB came in with the sweet chin music on them.
No, that's right. They are down year to date 29%. And I think what's interesting, I started initiating a position in Qualcomm in the fourth quarter of last year. It was actually right around where we're buying it now. It was right in the 130s. I grabbed them, and then out of nowhere, I'm going to put up the stock chart here. The stock price just took off in November. It jumped up immediately almost to the 160s, 190. I was kicking myself. I was mad that I didn't initiate a larger position in Qualcomm. Now we're back down to in the 131 per share range. So I'm taking this as my opportunity to correct what I didn't do before and build this into a little bit more substantial position for Qualcomm here. And when we run them through our stock screener, you're going to see why I'm building my position here, at least in the short term.
That's the beauty of investing, is you learn along the way what you could have, should have done. Hopefully you have enough time ahead of you to learn from that and implement going forward, like Bert's about to do with Qualcomm. Again, that first dividend diplomat stock metric, the price to earnings ratio. So as of May 20th, that stock price for Qualcomm is $131.60. So like Bert was saying, right around where he was buying it in the fourth quarter. So here we are looking at analyst projections at $12.59 for earnings. That leads to a very low price to earnings ratio, almost below 10 at 10.45 B.
Yeah, it's absolutely insane that it's that much of a discount to the market. We know tech's been getting slammed recently, so it's not surprising that their stock is down 29% and their PE ratio continues to fall. Let's move into that second metric here, the dividend payout ratio. Annual dividend, $3. Divide that by the 12.59, that gives you a payout ratio of just under 24%.
Love it. Yeah. Give me some dividend increases, right? Come on, Qualcomm.
All right. 5-year dividend growth rate here, moving at their metric, 5.10%. Dividend increase for 11 years as well, just like Starbucks. But there is a caveat here at that 5-year dividend growth rate. Just last month, Qualcomm announced a 10.2% increase of their dividend, which was more than double their 5-year average.
On the way up. Let's go, Jefferson's. Qualcomm. Wow, higher dividend growth now than their average. I would expect more of that in the future. Would you agree, Bert?
I would agree. That dividend train starting to leave the station here. Sorry. Yeah.
Up on that train. All right. So the dividend yield now has swelled for Qualcomm. Again, being a tech stock, you don't really typically get yield with your tech stocks. But Qualcomm is now yielding at 2.28%. Ooh.
Yeah, it's fantastic. I mean, yeah, to your point, you hit it right in the head. Tech stock, over 2% yield, definitely interesting there. So let's summarize Qualcomm here. 10.45 PE ratio, 23.83% PE payout ratio, 5.10% 5-year dividend growth rate. Although they did just announce that 10% increase, 11 years of increasing that dividend in a row with a 2.28% yield.
There we have it. All right. It's time. It's time to go back into our favorite industry, our favorite sector. We're talking banking, baby. And Bert's not only been buying a bank stock or watching a bank stock, we're going back into the good old state of Ohio, the Buckeye State. We're heading down 71 South. We're trying to get to the headquarters because, Bert, what is this bank stock you've been loving?
Huntington Bank, ticker symbol HBA. And I was laughing because one of our recent commenters said, what are your thoughts about Huntington Bank? And I'm smiling because I've been buying Huntington. I was getting ready to talk about it in some of these upcoming videos. Although that commenter said, what about a community bank like Huntington? I don't think you can call Huntington Bank a community bank. They are a top 20 bank. They have over $176 billion in assets as of March 31st. That probably is the size of all the community banks combined in Ohio if you're going to do that. And it's still probably double that based on the size of some of those small ones.
Wow. So Huntington, Bert, that stock price has come down to $13 per share. They're down almost 18% this year and about 18 almost percent on the last 52 weeks. So they're getting pummeled. You know, obviously banks are all dealing with interest rate risk with all the loans they were booking in the past at lower rates, historic lows. Now rates are rising, putting a little bit of interesting pressure possibly on earnings with the rise of cost of funds, but still they should be able to lend out at a better clip now going forward. For what's that first dividend diplomat stock metric look like on this Columbus-based bank?
All right, so we're going to throw two metrics in for the valuation standpoint. PE ratio, their current stock price is 1302. EPS is $1.38. That PE ratio is 9.43. But as we always like to disclose with banks, banks are valued based also on the price to book ratio. That is the metric that you use. You calculate the price over the book value per share of their equity here. Typically, we look for what, landing between over like around the 1 to 1.2-ish range are typically the cheaper price to book ratios. That's what, if it's over 1.25, I'm going to kind of hold off. It better be JP Morgan if you're going to be above that and we're buying it. Huntington Bank's current price to book ratio is 1.15x. So it's pretty cheap from that metric standpoint, in my opinion.
1.15. That is very nice, actually. That's pretty good value right there on Huntington. So to look at that second dividend diplomat stock metric, that payout ratio, that safety in the dividend. Well, Huntington pays right now 62 cents per share per year. We have another perfect payout ratio on this list at 44.93%, Bert.
This is great for banking because is what you said too, Lanny, earlier, something that resonated. They're going to be facing some interest rate pressure, especially with increasing costs. In the event they can't grow their loans and their interest income on loans at the same clip there, and you see some compression on the earnings per share side too, there's plenty of room for Huntington to currently maintain its dividend and grow it going forward. That's why we love seeing it in that perfect payout ratio range.
There's always money in the banana stand. So guys, looking at that third dividend diplomat stock metric, that dividend growth, they've been increasing the dividend for 1 year, and they've been doing it at an average 5-year average rate of 16%. Now, Bert, what's the caveat here with the 1 year?
Okay, I'm happy you brought that up because I was going to say it there. If you recall, during the pandemic, the Fed put the kibosh on bank stocks increasing their dividend because they didn't want to have another issue. They want to make sure the banks were properly capitalized to maintain potential losses that would have come from the pandemic. Potential losses never came. There was that quick turnaround there. A year later, the Federal Reserve said, all right, bank, you can release the crack and we're good. We evaluated your balance sheets. You're well capitalized. Start increasing that dividend again. And Huntington was part of the group that increased their dividend there.
Huntington's like, I'm back, I'm better than ever. So look at that dividend yield. We're looking at an almost 5% yielder. Yeah. Huntington Bank, HBAN, yields 4.76%.
Yeah, isn't that wild?
It's great. It's great.
Yeah, it's there. So let's summarize their metrics here. PE ratio 9.4, price to book 1.15, payout ratio 44.93%. 5-year dividend growth rate is 16%, but that's a little skewed because they had some big increases towards the front end of that. They've increased that dividend for 1 year, and that yield is 4.76%.
All right, guys, we're going to show all three stocks here on the screen because Bert's watching Starbucks, Qualcomm, and Huntington. What dividend stocks are you watching during this upcoming week of May 23rd? What stocks are you buying right now? Let us know if you're building that passive income stream.
That's right, everybody. I'm curious what your thoughts are about these three companies that I'm going to be watching here. And stay tuned for our upcoming video on Tuesday, too, where we talk about my watch list here. Tuesday's video is going to be Lanny's dividend stock watch list, too. So you're going to see 2 more undervalued stocks to buy coming up in our next video release.
All right, if you haven't already, definitely subscribe to the channel. Give this video a thumbs up. That was Bert, the Hurt, and Lanny from the Dividend Diplomats. Over and out.